Matt Walsh and Nick Carter are partners at Castle Island Ventures. All views expressed by them or the guests on this podcast are solely their opinions and do not reflect the opinions of Castle Island Ventures. Guests and hosts may maintain positions in the assets discussed in this podcast. You should not treat any opinion expressed by anyone on this podcast as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of their personal opinion. This podcast is for informational purposes only.
Hello and welcome back to On the Brink. I'm Nick Carter. This is the second episode in the Stablecoins 2.0 mini-series, a series where we explore the changing trends in stablecoins. For the first one, we heard from Martin Carica, the founder of an interest-bearing stablecoin. Today, we hear from Peter Johnson, the co-head of venture at Brevan Howard Digital, and one of the loudest, most strident voices on stablecoins over the years. Peter also invests behind his convictions. So he's one of my favorite commentators on the stablecoin space, period. Peter and his team came out with a great white paper recently entitled The Relentless Rise of Stablecoins, which we'll link in the show notes here. In this episode, we talk about Peter's prior predictions on the stablecoin space, how those fared, his main learnings from the Relentless Rise white paper, stablecoin trends in the US and why he's excited about PYUSD, the emergence of new stablecoin models, in particular synthetic USD stablecoins, comparisons to the Eurodollar market, and then I also asked Peter for his future predictions on the stablecoin space. I want to thank Peter for coming on. He's one of my favorite allocators in the venture space and one of the most clairvoyant voices on stablecoins. Let's dive right in. All right, so I'm sitting here with Peter Johnson, the co-head of venture at Brevan Howard Digital. Did I get that right?
That's right.
And one of the main stablecoin mega bulls historically, is that also fair to say?
That is very fair to say, yes. I have spent an immense amount of time on stablecoins. I think you have spent even more time on stablecoins, though. So it's great to be talking to you about it.
I think you're ahead of me right now. You came up with this great report. We're going to dig into that. I think you're probably earlier on the record being a stablecoin bull than I was.
Maybe earlier, but I think you've been louder.
I was trying to look back at your old stablecoin predictions. I feel like every year you do predictions, and every year there's something about stablecoins in there.
There is. Not every year. Started in 2019, which is when I really started doing predictions.
All right. So should we dig those up then?
Let's do that.
We've got the ascent of Bitcoin and stablecoins, Jump Capital's mid-2020 crypto theses. And what did you say about stablecoins?
I think stablecoins that year. So first year, 2019, I said there was going to be significant stablecoin growth. And it went from 3 billion to 6 billion that year. And then 2022, I think I said there was going to be exponential growth. And it went from 6 to 30 billion that year. And then 2021, I said stablecoin market cap would go over 100 billion, and it got to 140. And then 2022, I said it was going to go to 500 billion, and that one was totally wrong.
Yeah, that didn't happen. I should have actually dug these up more carefully, but I would say directionally very correct over the years. You called it a killer app in that 2020 article, which I think now people are acknowledging stablecoins are the killer app. So that's great. Anyway, the point is, you've been early and right on this. For sure. With the exception of 2022, but that was just a crazy year. We're going to just forget about that one entirely.
I think that's good for the industry.
So what was it about stablecoins that got you so fired up in the first place? Was there a moment that you specifically can recollect when it comes to stablecoins, or was it a gradual awakening?
More of a gradual awakening. I do recall. So I joined Jump in 2013. First employee at Jump Capital, which is Jump Trading's venture capital arm, and started Jump's crypto venture investing strategy in 2014, 2015. And early on, I had a lot of conversations with my partners at Jump about Bitcoin and the value proposition there. And I was able to, I think, pretty convincingly convince them that the value proposition of open network, permissionless value transfer, everyone pretty much got that. The part that was more difficult to convince people of was that Bitcoin as a unit of value was going to be accepted, that people are going to transact in Bitcoin. And so from those conversations, it became pretty clear to me that crypto as a payment rail would be better if it was transacted or denominated in dollars, which I think is a pretty obvious conclusion. So then when 2017, 2018 came along, Tether really exploded, went from, close to nothing to $3 billion outstanding. That's when it became pretty clear to me, like, this is the killer use case, or a killer use case for crypto. This is really working. That's when I really started to spend a lot of time on it. And it was probably around that time that me and you started interacting and talking about it.
What is your best explanation for why it's better to transact in dollars than a variable unit of account? I have my own reasons, but what would you say yours are? It's like a completely obvious question, but also...
I think it's kind of obvious. It's like, why would you want to transact with something that you don't know what the price of something is going to be, what the value is going to be from day to day? Like, that's just not the way that commerce works. And I don't think it will work that way. So the case that something like Bitcoin will be used for buying coffee with Bitcoin was kind of the old thing that people would say. I think it's just kind of a fairy tale because, like, nobody wants to transact in a unit that's moving around all the time.
The devil's advocate there is, well, people transact in unstable sovereign currencies all the time. Virtually any other non-developed world sovereign currency is variable. But I guess in those cases, I think the really precise point I would make is sovereign currencies are advantaged from an accounting and tax perspective. So you're not on the hook. You don't have to do all this complicated capital gains accounting when you accept some fiat currency and then you spend it on something later. With Bitcoin, you do. So I think that specifically is something that disadvantages native crypto assets as a transactional medium.
Yeah, I would completely agree with that. I also think that currencies that are highly volatile or have high inflation, people and businesses in those jurisdictions would rather transact in dollars. Like, they would prefer to not have something that is highly volatile if they could.
Totally. What is the main value prop of stables over legacy transactional rails for you? Is it the notion that everybody is united on a kind of a single flat network as opposed to this kind of highly intermediated network? Or is it the programmability? Is it the fact that it's open read, open write access? What's the killer thing as you compare it to, like, the way that actual dollars move around?
Yeah, I think that there's a couple things. There's access and efficiency. And to me, the access one is by far the dominant value proposition, in that stablecoins give effectively anybody in the world with an internet connection access to US dollars. They can save, transact, spend in US dollars. And that is something that for vast parts of the world, they cannot currently easily do. And that is the killer use case. And that is, if you looked at where stablecoins started, it was access. It was access to traders and exchanges that couldn't get US bank accounts. And stablecoins allowed them to transact in dollars, have dollars as a base pair, et cetera. And I think that has brought into uses outside of trading, but the core value proposition has largely been access. I think over time, we're seeing more usage because it also can be more efficient than the corresponding banking system, for example. But I think that at least to date, and in the near term, the really groundbreaking thing that stablecoins do is that they give effectively anybody with an internet connection access to dollars.
And I don't think people appreciate how important this is, because the vast majority of people listening to this are basically Americans. And it's such like a cliched point, but you really do have to externalize yourself from the American economic context to understand this. A US dollar bank account in an emerging market is something that only the elites have, just factually, and nobody else has it. And now that's completely changed.
100%. You talk to people in the US about stablecoins, and I would say most people, the value proposition, it doesn't really resonate with them because they have access to dollars. The US payment system works great. Why would they use stablecoins? And I would agree with that. Why would most people in the US use stablecoins? It doesn't add significant value to them. But you go to Mexico City or Bogota or Buenos Aires and you talk to people there about stablecoins, a lot of them are already using stablecoins. Huge numbers of them are using stablecoins. And the value proposition is extraordinarily clear. Like, you don't need to sell them on this. You just say, hey, there's an app that you can get dollars. Are you interested in that? And yes, I'm very interested in that.
And there's another point, which is in some of these places, dollar accounts have been things offered by banks. Like you could have had a dollar denominated account historically in Argentina. I think not today. Obviously, that ended in chaos back in 2001. In Turkey, I think you can still have one, but it's not a credible dollar account. It's a access to dollars that's intermediated by a local banking system, which is often Ponzi-like, effectively, or on the verge of collapse, right? So the difference is you have dollars in a digital wallet, and your relationship is ultimately indirectly with the issuer, USDC or Tether, and it's not with a local bank, which is beholden to the local political trends. So I think that's a really key thing is, yes, maybe in some cases you could have a dollar account at a bank, but those dollars are not yours and your access to them can be withdrawn.
100%. Like the value proposition, if you don't have access to dollars, it's pretty obvious. But there's also a very strong value proposition for people around the world that have access to US dollar accounts, but do you trust the financial institution that dollar account is at? And how does that dollar account interact with other dollar accounts in different countries? I think one of the things that we're going to talk about is like, are there like tangible examples of people using stablecoins that really stuck out to me? And there's a lot, but one that I thought was really interesting is there's a guy that I used to work with who came from Eastern Europe, and he would go back and forth between Eastern Europe and the US. He had dollar accounts in his home country and in the US, but moving dollars from the foreign bank account to the US bank account was highly costly. And the least expensive, fastest way for him to do that was to go into the bank in one country, take out physical cash, get on a plane next time he's going across the ocean, go to the bank account in the other country and deposit that cash. That was the best way he would do that. And he would do that on a regular basis. And once you start talking to people about these issues, that is actually a fairly common story I hear of people taking out physical cash, getting on a plane and bringing it to a bank in another country, because that's the most efficient way to do it, which is absolutely crazy.
Yeah, I mean, Miami is a big hub for this in LATAM. Folks in Latin America literally bring wads of cash into Miami, go to Bank of America. Actually, specifically, Bank of America is one of the ones that is favored by foreigners. Deposit the cash. And then you have your offshore, so to speak, bank with dollars in it. So I want to talk about the DeFi mullet, this idea of fintech on the front end and stablecoins or crypto on the back end. So I think we're both very excited about this theme from an investment perspective. Tell us a little bit about that, about the notion of these money, either remittance apps or e-money or mobile money apps that look like traditional kind of Web 2 fintech experiences, but are powered by stables. How widespread is this? I think I did a tweet about it recently. People are asking me, well, does anyone actually use this? So how advanced are we? How developed is this kind of cohort?
Yeah, we're definitely starting to see these take off. And it's a lot of them look like traditional fintech apps, but they're using stablecoin like infrastructure on the back end. And why do they do that? For a variety of reasons. One is that you can offer dollar accounts to a lot more people with that. It's faster and cheaper, oftentimes, to send remittances for the reasons that we discussed, going through the corresponding banking system. It's slow, it's very expensive. Those types of things. It gives people the option to self-custody if they want to. And a lot of these apps will give you the option that it can be custodial, it can be non-custodial. And it makes it very easy to move from your local currency to stablecoins and transact in whatever currency works best for you. And that's just a huge value proposition to a lot of people in a lot of places. And we're seeing more of those types of applications. And that's an area I'm really excited about, is that application layer. We'll talk about the data that we're seeing, but we're clearly seeing massive use of stablecoins. And a lot of that currently is going through crypto exchanges. It's just going through crypto wallets. It's user experiences that are not built for purpose. And as we get more applications that are built to broaden the user base that is comfortable using this, I think we're just going to see more and more usage.
Yeah, I think what people don't realize about Binance is they were that first global bank for people that wanted to hold these basically offshore crypto dollars, but they weren't built for that specifically at all. I mean, onboarding with an exchange is this complex, complicated, scary thing. So I think people have now realized this and begun to build these specific dollar app style experiences, and without doing it through the exchange front end. So very exciting to me.
Yeah. And I've actually been surprised, and I think you have been too, about the speed that this has occurred. I thought a lot of these would get built years ago, but it's taken longer for whatever reason for these applications that are more specific to non-speculative use cases to really emerge. But I think we're starting to see a lot of them now, which is really exciting.
Yeah, we've invested in these for years, and now seems to be an inflection point. I don't know why now. I mean, currencies have been unstable forever. The dollar has been something that people have wanted in emerging markets forever. Stablecoins have worked for years and years. But I'm encouraged by it. It's my favorite sector at the moment.
Me too. We've seen a shift in the founders that are building these types of applications, and that I think the first generation of founders building these were often more maybe revolutionaries would be one way to say it, is that they wanted to kind of fight the governments in the countries that they were building them in. And I think the next generation is a little bit more pragmatic. And they also oftentimes come from fintech backgrounds. Like they built successful consumer fintech products before, and they know how to run that same playbook, but run it on better rails. And I think that that is the way to have success here.
And I think one precondition here is the first and last mile has to be built out, which is those connections to the local fiat. So if you want to do an end-to-end remittance, you need to be able to go from local fiat to crypto to local fiat. So obviously it's trivial to do the intermediate payment, but then it's the first hop and the last hop that are the difficult hops. And I'm curious for your view on this, because my understanding is that where centralized exchanges don't exist, of course, the peer-to-peer exchanges fill that gap. And that's definitely what we see, is we see a lot of these kind of stablecoin based remitters will utilize the P2P markets in countries where centralized exchanges are not permitted for whatever reason. But also the P2P exchanges have been challenged of late. So I think Paxful, I'm not sure of their status, but I think they're kind of troubled. Local Bitcoins, I think, indicated they're going to shut down. Binance P2P has been receiving tons of scrutiny. I think Binance P2P is the number one. So what do you make of this? The necessity of these P2P markets in places where the centralized exchanges aren't prevalent, but the fact that they're also kind of under the cosh right now.
Yeah, so both the centralized exchanges and the peer-to-peer networks are key infrastructure on why you can build these applications now. Like you couldn't do this several years ago because there wasn't stablecoin liquidity in basically every major country in the world. And now there is. So like you can go in and out of stablecoins in almost any exchange in the world, except for places where regulation doesn't allow it. And then you have the P2P networks, which are flourishing in a lot of these places, but are under pressure, oftentimes from regulators. So yeah, I think that that is a threat to some of these models, is that, if you've choked out the centralized exchanges, and then if governments are able to choke out the peer-to-peer networks, that makes it really hard to operate in some of these jurisdictions.
Yeah, we've seen governments being pressured, though, actually, by populations that have already embraced stablecoins and these kinds of networks, pushing back at proposed bans. So I think it is a bit of a give and take, which is pretty encouraging. So I want to talk about your Relentless Rise of Stablecoins white paper that you published. I was very impressed by it. Thank you for doing that. This was a lot of work and presented some novel data that I've never seen before, especially on a cross-stablecoin, cross-chain basis. So I guess to start, what was it that prompted you to write this now?
Well, thank you for saying that. That means a lot coming from you. What prompted me to do the paper is that I was continually hearing two narratives from both people inside and outside of the industry. And these are two narratives that I've heard for a long time, especially the first one. And the first narrative is that crypto is all about speculation, is that there's no real world use cases. We're still searching for killer application for crypto. It's all just gambling. And the second narrative was that stablecoins, and this is a more recent narrative, but that stablecoins are not getting traction, or that stablecoin usage was declining. And I think that that narrative is from people just looking at incomplete data. So I thought both of these narratives were likely untrue. And I thought that looking at the data would help uncover, are these true or not? And overall, like you, try to be very data driven in the way that I look at trends, and certainly thesis driven, but then you look at the data to validate if your thesis is right or not. So this started about a year ago. I put out a short article, which was called "Where's the Beef?" And that was basically using data to highlight non-speculative use cases of crypto, stablecoins, and how brands were using digital goods and a couple of other things. And as part of that, I got the data on the percentage of stablecoins which were held on exchanges, which was pretty easy to get for Ethereum, was harder to get for Tron. And that got me on the path of wanting to look at all sorts of different data and holders of data. What were the entities that were holding distributions by coins and by blockchains, and all of these things that I ended up looking into because I thought that would help. If you looked at all of these things, there's going to be some truth that hopefully comes out of it and what is actually going on. And with blockchain data, it's often not definitive, but it's pretty indicative if you get enough data. So I said, okay, let's find a way to get all this data and look at these trends. And what I found, which was interesting, is that there really wasn't this data available, especially for Tron, is that most people that were looking at stablecoin data and quoting stablecoin data, they were looking at ETH main chain data. If they were a little bit better at what they were doing, they were looking at Del2s and some of the other EVM chains, but they weren't looking at Tron data, which is just a massive gap. Tron is 40% of weekly active addresses, but half of volumes are on the Tron blockchain. So if you're not looking at Tron, you're just missing a huge part of the story. So that was a big part of the work, was figuring out how to get the Tron data. Ended up working with Coinmetrics and Allium for that. Both great companies, in particular, Ethan at Allium just stepped up, really helped get that data for us and index and run the queries. We ran all the queries ourselves at Brevin, but the data providers were really helpful in getting this data, which I was surprised that it seemed like maybe no one else had asked for this data before, which is really shocking. So we got that data, ran the queries ourselves, and got to the data for the report. We would have also liked to get Solana data. We did not get Solana data into the report. Solana data, much like Tron data, except even, I would say, to a more extent, it's just a lot of data. It's hard to store. It's hard to index. It's costly to work with. Data providers don't really have it easily available. We could have gotten there, but it was, after working on this for several months, we put our deadline on ourselves and we didn't get the Solana data in there, which I'm okay with. Solana, stablecoins on Solana, it's about 2% of supply, and less than 2% of supply, 2 to 3% of transaction volume. So it's not a huge gap. But yeah, so that is kind of what led to doing the report and how we got it done.
Yeah, I mean, having obviously been inside of Coinmetrics for all these years, I can attest to how difficult it is to work with some of these larger blockchains. But you can't ignore them. And I think Tron has been the elephant in the room for stablecoins. I mean, it's all about Tether on Tron. That's just a fact.
Huge amounts of Tether on Tron. Yeah.
And it's just very different behavior patterns too. Like USDC holders, users are very different from Tron users and holders. You look at the time zone analysis, you see it's just completely different geographies. You look at the average transaction size, different sizes, different usage modes. Stablecoin transactions tend to be smaller. ETH, Tron, or USDC on ETH transactions tend to be larger. So people treat it as an aggregate homogeneous mass. It's just not. There's all these different sub-niches within the stablecoin space. So I thought you did a really good job of picking those out and making that more legible. I think one of the best charts is actually the weekly active addresses and weekly active transactions for stablecoins. That's just continual linear growth. And you overlay that against the stablecoin market cap. Stablecoin market cap is actually trending down, flat to down. I would say down. It is about depends on what you count. Peaked at, let's say, 185 bill, around 120 bill today. Still been declining, actually. But despite that, you see usage in other ways, transaction count, weekly active addresses is rising. So it paints a very different story from the more common data people have access to with stables. What do you attribute that to, the discrepancy there?
Yeah, so I think that part of, like you said, part of the discrepancy is people looking at incomplete data. Like if you're just looking at Ethereum blockchain data, you're going to see a very different story than if you include Tron data, if you include BSC data, et cetera. And I think that what we've seen is like the weekly active addresses, number of transactions, that just, it's straight up, like with some bumps, but it just relentlessly grows. And volumes have been very resilient. So volumes since the beginning of 2022 on exchanges, centralized exchanges and decentralized exchanges are both down over 60%, while stablecoin on-chain volumes are, let's call it roughly flat. And then active addresses and number of transactions are meaningfully up. So I don't know how you can look at that data and conclude anything other than stablecoins are being used for a lot of things other than just trading. Comparing those two data sets, I think, leads to that clear conclusion.
Yeah, if I could tattoo those two charts into the eyelids of every pundit that weighs in on crypto, it would be those two. Crypto exchange volume, the speculative proxy for speculation, versus stablecoin usage. And they've decoupled, as you say. This means that there's something real. We don't know what every transaction is for. I mean, I would love to know. We don't know. I don't think anybody has been able to tell me that. But we know that there is some desire to use stablecoins and to pay for it with fees on public blockchains for transactional purposes that is not perfectly correlated to the mere exchange volumes. That much we know.
100%. Yeah, I think I don't know how you argue with that.
So actually, this is the question I get all the time, which is like, who are these people? Who are these Tether Tron users in Asia, Africa, Eastern Europe, Latin America? What are they doing? Why do they like stablecoins? I've never been able to give clear answers to that. We just have anecdata, so to speak. These got stories of importers importing Chinese goods to Nigeria, settling in stables. There's stories. We know that there's fintech apps, people using all these emerging markets, holding dollars through that. What would you say to that? Because I get this question all the time.
Yes. And I would love to be able to say more definitively, like what exactly it is. Unfortunately, based on the stablecoin, based on the on-chain data, you can get these trends, but you can't say exactly like what is this transaction for. What I can say is talking with a lot of different people in these different countries, there are a bunch of different use cases, but they're definitely real. And there's definitely strong usage of especially Tether and TRON. That's the default in a lot of these countries. And they're using it for a variety of purposes. Talk to people that are in Latin America and they want to buy online advertising into the US and they need dollars to pay for that. So how do they do that? In some cases, they can do that with stablecoins. There's people that are doing work for US companies in different countries and they want to get paid. And stablecoins are a great way to do that. But there's people in Argentina and they just want to get out of the local currency oftentimes. So like the use cases are various. There are just people that already have dollar accounts in multiple countries, but moving the dollars between those accounts is slow and it's costly. And then they see what they can do with stablecoins and they're just like, this is a more efficient way to do something that I can do, but is not a good way to do it. It varies by country. It varies by the issues in that country, like what those people are looking to do. But it definitely is, it's very significant. It's really interesting to go to. I was recently in Mexico City and Bogota, and you go to some of these meetups and you just talk to people about these things. And it is almost shocking when you talk to people about, hey, like, do you know what stablecoins are? Do you use stablecoins? And some of it might be biased by the meetup you're at, even if they're not crypto meetups, they're tech meetups. So these are tech forward people. But generally, people are they're oftentimes users of stablecoins, even if they're very skeptical of crypto. A lot of people in these countries, a lot of people have gotten burned by crypto, and they're very skeptical of crypto assets, but access to dollars resonates with them very strongly.
So in 2020, I had this thesis about crypto dollarization. I looked at prior dollarization events, and it had occurred to me that the scarcity of dollars was one reason some of those dollarization had failed or been incomplete. And I thought that because now stablecoins were distributing dollars directly without intermediation through the banks, which was one means through which dollarization had been controlled, was the banks themselves, I thought it would be more rapid and more prone to occurring dollarization events, particularly bottom-up style dollarization, the likes of which we saw in Ecuador in the early 2000s. And I would say this hasn't happened yet. I mean, I don't know if I can consider a thesis void if I've only had it for 3 years. What do you make of this? Do you think stablecoins make dollarization more likely to happen and less frictional when it does occur? How do you see the existence of stablecoins as interacting with the monetary privilege of some of these weaker, from a monetary perspective, emerging market nations?
Yeah, I also had that in one of my predictions, I think probably a few years ago, and it hasn't happened as quickly as I might have expected. There is more use of dollars in a lot of countries because of stablecoins, and I think it's happening in a ground-up fashion, but we haven't seen like mass dollarization like I thought there was the potential to maybe occur. And yeah, I think that there are political forces that obviously deter that from happening on a mass scale, while you can have people increasing to use dollars on a day-to-day basis without seeing widespread crypto dollarization. I think that's probably where we're at right now.
Yeah, I've been interested to see what happens in Argentina. Potentially, Milei's platform is one of dollarization, and a lot of Argentines are able to access dollars through the stablecoin vehicle today. I mean, we know that for a fact, even if the dollar access is a gray or black market activity. So I don't know if that's evidence maybe that you could point to show that they want dollars, if it makes dollarization easier. That's something I'm tracking, and we'll see what happens there. But it does occur to me that dollarization is often, the vast majority of the time, in fact, done from the top down, and it's a political decision that's made. But there are examples like the Ecuador one, which is considered more bottom-up. So in the white paper, we talked about some of these things. You compared stablecoins to fiat settlement networks. So obviously there's subjectivity in the data, like the adjusted transaction volume figures that exist to determine sort of the fiat value of transactions on a blockchain. That you can never know the ground truth there. There's always subjectivity, but stablecoins have had some key milestones relative to their fiat counterparts. So what did you find there?
Yeah, and I think that these are some of the stats that really catch people's eyes. So I compared stablecoins to PayPal, Visa, ACH, and Fedwire, which are obviously large differences in the purpose and operations of those payment and settlement systems, but I think it gives a really good sense of scale. And what you see in transaction volume, stablecoins last year actually did close to 10 times the volume of PayPal. Stablecoins settled over $11 trillion on chain. PayPal was about $1.4 trillion that went through the PayPal network. Visa did about 11.6 trillion in volume. So stablecoins and Visa almost on par right now. And then stablecoins compared to ACH, stablecoins was, I think it's like 13 or 14% of the volumes, and then like 1% of Fedwire. So that is like transaction volumes. If you look at the number of transactions, networks like PayPal, Visa are doing significantly more, 10 to 200 times more. Number of transactions, stablecoins are doing, like, let's say 5 times the transactions of something like Fedwire, which again goes back to like these are different purposes for these different networks. Some of them are low value, high throughput type networks. Some of them are high value, low number of transactions. So one, I think that people seeing that on-chain stablecoin volumes, this isn't including any on-exchange volumes, this is just actual on-chain settlement, is 10 times PayPal and the same as Visa. Like that catches people's eyes. That's really interesting. And trying to think of like the analogy of which of these it's like, it's somewhat hard because in the traditional system, these payment rails kind of play in their own box a little bit more. Like PayPal and Visa are more low dollar payment systems. ACH and especially Fedwire are, very high dollar, low throughput systems. And stablecoins can be all of these things. Like you can do low dollar payments, you can do micropayments. It's great for micropayments, but it's also great for multi-$100 million payments. So you can kind of do everything with them. I think that if you actually look at the data, like how are stablecoins being used, the majority of transactions are small dollar transactions. So part of the analysis that we did, we looked at week for addresses that are active in any given week, how much are they transacting? And 75% of active addresses are sending less than $1,000 per week. So it's a lot of smaller, more retail type transactions that stablecoins are being used for. And then the averages are pulled way up because you have these outlier big transactions. So if I had to compare like what are stablecoins most like, if you're comparing it to the traditional payment rails, I would point to PayPal because the majority of transactions are kind of small dollar type transactions. And they're also similar in the structure in that they're both kind of over the top payment networks. You hold actual cash in a bank account. You keep a over the top ledger of people's balances. You settle out when people want to settle. Difference obviously being with PayPal, PayPal is keeping that ledger. For stablecoins, you're keeping that on a decentralized consensus ledger. And because of that, stablecoins are open network where PayPal is closed network.
Yeah, the PayPal analogy is an excellent one. I mean, many have said that PayPal itself is effectively a stablecoin. It's just that its database is not legible to the general public.
Exactly. Yeah.
I wrote a piece some years ago called Transaction Count as an Inferior Measure, and I plotted aggregate yearly volumes flowing through these networks versus transaction count. And there's basically an inverse relationship. You have to plot out on a log scale because the numbers are so whacked out. But you got the FUD wires on one end, on the bottom right, relatively few, very large transactions on average. And those tend to be kind of push networks and kind of like more final in their settlement characteristics. Then on the other end, sort of top left corner of the graph, you have high transaction count, low average transaction value, pull style or batched style payments that are less real time. And yeah, I could never really decide where stablecoins fit in that, but you can certainly plot them on the chart. I have maybe a bit of a different opinion. I thought they were more analogized to these like larger like wire transfer style payments, because I know in theory the settlement isn't actually final, but in practice it's generally final. The true ledger is actually maintained by the stablecoin issuer, and the blockchain is merely indicative. And those transactions can be rolled back in some cases. But to me, it feels like a real-time gross settlement, final network. But yeah, of course, the issuer can unwind individual payments if necessary.
I like that framework that you had, which was from, I think, 4 to 5 years ago. You're comparing Bitcoin to them. It's a very interesting framework.
Yeah, I need to refresh it. So let's see here. We have a lot to get through still. I want to talk about Eurodollars. So stablecoins basically are Eurodollars for the most part, or tokenized Eurodollars, but they also resemble the emergence of Eurodollars from an analogy perspective. You look at the 60s and 70s when Eurodollars emerged. There's a good Odd Lots episode on Eurodollars recently, which really activated my almonds on this piece. So I see my own analogies, but curious if you see them. How does the rise of stablecoins resemble the rise of Eurodollars, if at all?
Yeah, the podcast at Odd Lots with Josh Younger, I think is the best podcast on stablecoins that doesn't mention stablecoins. It's incredible. And Tracy Alloway is talking about Eurodollars as free range dollars. And it's basically describing stablecoins. So you should get Josh Younger on the podcast to make it more explicit.
See what I can do.
I think that'd be really interesting. But yeah, the comparison to Eurodollars, I think, is at a high level, like a very obvious one. Like Eurodollars are US dollars outside the US banking system. That is exactly what stablecoins are.
Most of them. Do you consider USDC in that cohort as well?
I think you could argue that it is, because once the stablecoin is issued, then it can travel around the world. And it's, I think, kind of at that point outside the US banking system. But I could see the argument against that as well. But like you said, like the growth are the drivers of growth. Again, it's very similar. It's like, why do people want US dollars that are outside the US banking system? Like one is just access. Like if you don't have access to a US bank account, but you want dollars, and there's a way to do that, like that's driving this. And then there's also just benefits that you can have from having dollars outside the US banking system. It can be more convenient, it can offer more privacy, it can be more interoperable with your other accounts. Higher interest rates are what drove a lot of the Eurodollar demand. And I think we could start to see that in stablecoins. We're not there yet, but it's something that you've talked about driving a lot of demand in the future. And I think we certainly could see that. So the analogies on the drivers, I think, are very clear. And I think that it also offers a good benchmark for stablecoins, because Eurodollars, which is not very well tracked, it used to be very well tracked by the BIS, and Milton Friedman wrote about it. Recent years, it's not well tracked. And I think that's because the use of derivatives makes it actually a little bit harder to define exactly what is Eurodollar. But if you take a conservative estimate, I would say there's $10 trillion of US dollar deposits outside the US banking system. So like I'd say that that's a benchmark for where we could be headed for stablecoins. And that's 100x where we are today. I think that that is very achievable on a long enough timescale.
Yeah, I looked at some of those old BIS reports. They're actually quite good stuff. I hate to praise the BIS, but they actually were pretty good on Eurodollars back in the day. And I think inflation-adjusted stablecoins are in the equivalent of 1967 in terms of the growth of the Eurodollars market. So obviously Eurodollars inflected when you had the petrodollar emerge, you had the oil crisis, the Nixon shock. That's when a real reason emerged, I think, to, offshore the deposits from the US dollar system. And we haven't had that equivalent inflection moment in crypto. Even though you could say 21, 22, there was an inflection. And actually, I do think higher yields drove the growth of stablecoins at that point. like crypto native yields. It's just that they didn't prove to be very durable. And now we have a different kind of yield emerging on stables, mostly offshore or maybe exclusively offshore due to securities laws, which is basically tokenizing treasuries, wrapping that in a stablecoin format, which we're seeing, and also crypto native yields deriving from the basis trade and the fact that Ether itself has a native yield to it, which it didn't before. So I've been on record saying I'm very excited about this. I think this is these kinds of protocols, stablecoins that externalize the yield, pass it along at least a significant fraction to end holders and users. I think that'll become a very meaningful portion of the market cap. I think you're maybe a little more conservative on that, but yeah, talk me through these new models for yield, which ones you like, the tokenized treasury versus the crypto native, and where you see that going. Is that just going to be an ex-US thing? Will eventually be in the US?
Yeah, I agree that I think that these are really interesting models. And if you think about like where are the opportunities for disruption on the stablecoin issuance side, I think they are interest-bearing stablecoins and then new entrants that have very strong brands. I think that that's where you would see traction come in. On the interest-bearing side, I think that both tokenized treasuries that pay interest are interesting. And then like you, I also think that the synthetic dollars using liquid staking tokens and short put positions are a really promising model. The issue, as you mentioned, is, or one of the things that I think will slow adoption somewhat, is that they're more complicated from a regulatory perspective. You need to stay away from the US. This would be largely probably considered a security in the US. In Europe, under MiCA doesn't allow interest-bearing stablecoins. So it puts challenges in those markets. Counterpoint to that is that US and Europe, probably not your target market for stablecoins, or at least I don't think they are. So there's significant opportunity there. And I do really like the synthetic dollar idea is something that I really liked for a long time. And I especially like it if you can do it in a fully decentralized way. Like, I think that is the way to create a fully decentralized stablecoin, which is something that I've wanted to happen for a long time. And for various reasons, it has not.
We're not there yet.
We're not there yet.
Open interest on the decentralized exchanges is just not, I think it's 1/25 of maybe the OI on centralized exchanges.
Exactly. That's the issue, is that ideally this is fully on chain. It's all smart contracts. You're not taking exchange risk, but the open interest is way too small. Like, it doesn't work at this point. You cannot do this at any scale in a fully decentralized way.
The other constraint would be there's also a negative feedback loop in terms of the value flowing into these kinds of stablecoins and the yield available from Ethereum itself. I mean, I think it's a big number, but as more ETH is staked, the yield comes down, as far as I understand it. So whereas with treasuries, for instance, a pretty arbitrary size there.
Yeah, tokenized treasuries is, for all intents and purposes, kind of infinitely scalable, whereas the synthetic dollar model is, at some point, like, they press the funding rate down, then you have negative yield on it, and then the market cap should shrink. The good thing about that is that it is a kind of self-correcting model. Like, you get too big, it pushes the funding rate down, should push the market cap down. So it somewhat self-controls itself from a growth perspective, which is obviously different than other decentralized stablecoins we've seen in the past, which had the opposite of that. So I do think, like, there's certainly limits on how big this type of stablecoin can be now, but I think it's the most promising model, and doing it with centralized exchanges is like the best way you can possibly do it right now, because doing it on DEX is just not big enough at all.
Yeah, this is something we've invested in the past with Bitcoin as the basis, but at that point, you're wholly reliant on the basis trade for Bitcoin. There wasn't any endogenous yield. So with ETH now, the yield life cycle being perfected, now it's really one of those things that's uniquely possible at the moment. It's always nice to see those kind of unlocks and then see how that enables actual real product innovation.
Yeah, it gives you a lot more margin for error there. I think it will be really interesting to see is, like, what is the equilibrium kind of basis and yield as these things get more efficient. And crypto is certainly not an efficient market, but as it gets more efficient, like, what is that equilibrium?
Because you would imagine that if it was way out of whack, people just borrow dollars, create the stable coin, earn that higher yield, depress the yield. So you do a carry trade, basically.
Once it gets above kind of the risk-adjusted return, they'll get arbed out. So just like, what is the risk-adjusted return that should get arbed down to?
So the other thing you mentioned was, and I agree as well, large brands entering the stablecoin space. Obviously, we have PayPal USD now been announced. You also have other larger issuers, at least contemplating stablecoins, thinking about it. You're pretty bullish on PayPal USD. I don't really have any views on it. But yeah, you were telling me before the call you're pretty excited about it. So curious to get your thoughts on that as well.
Yeah, I'm very excited about PayPal USD for a couple of reasons. Like one is just PayPal is huge. They have huge distribution. One, they're a very large company, like $70 billion market cap company. So they instantly become the most trusted issuer, I think, in the space. And they're just trusted from a brand perspective. There was a recent survey that they were actually ranked as the second most trusted brand in the world.
Wow.
So yeah, I found that amazing.
They've mistreated me personally. So clearly I wasn't consulted on that one.
I don't think the crypto community was surveyed in that survey, but whoever was surveyed ranked them as the second most trusted brand in the world. So there's massive trust. They're a massive company and they have massive distribution. They have over 400 million users worldwide. They have over 500,000 merchant relationships, including the majority of the top 1,000 retailers in the world. So if they want to push this through their existing customers and merchants, which they have incentives to do, they have massive opportunity to do that. And then the other part of this is for people who are not currently customers of PayPal. They don't currently have access to PayPal in various parts of the world. You can't open a PayPal account. This gives anyone in the world, you can now access dollars, the world's reserve currency, and it is issued by PayPal, one of the most trusted companies in the world. Like that is a combination that I think is incredibly powerful and I think will drive adoption forward meaningfully. And I think the pace of it will be largely based on how fast PayPal wants to push it. PayPal, my sense is that they will push it forward, but at a measured pace because they want to, regulators are more comfortable with that. But, the faster that they push users to use this, they might offer their own non-custodial wallet, offering it on more chains. It's just Ethereum main chain now, which is not great for small dollar transactions, obviously. So if they launch on layer 2s, on Solana, et cetera, all of these things, I think, could really push PayPal USD into the top, potentially the top stablecoin in a not very long period of time.
I've been surprised. I know Visa has been pretty active on stablecoins. Obviously, Kai Sheffield over there has been beating the drum for some time. Given Visa and MasterCard's global stature, maintaining not just credit networks, but also payments networks, I've been surprised at their reticence to enter the stablecoin space. And to be clear, they've both done things, but I've been surprised at the pace.
Yeah, I mean, they're both certainly very active. And Kai Sheffield is very smart, very plugged in. I think that they're doing a lot of things. Yeah, I think that the opportunity for them is how do they connect like their payment networks or connect the local payment networks of the world, which they have, and go in between those with stablecoins. Like that's, I think, the opportunity for them. I think it also is that stablecoins are potentially more disruptive to those business models. I mean, if you look at the fees that interchange fees that Visa and MasterCard charge, there was just another Wall Street Journal article, I think yesterday, on like those fees are going up. I forget the exact numbers, but they're massive, like double-digit billion-dollar type fees that stablecoins could be very, very disruptive to. So I think that is a potential consideration there.
It's interesting. Stablecoins themselves promote a new form of interchange in that some stablecoins will be interest bearing. And so if you are a float-based business, you now have a new revenue model, which didn't exist before. So I think that's going to be something that really makes stablecoins look much more attractive to existing fintech businesses if they have a native yield to them. So I want to talk about US regulatory. It's sort of not a very fun topic, and I talk about it every week on my podcast. So up to you what your appetite is. But I would say there have been like 10 bad developments in the US as it pertains to stablecoins this year, and like 1 or 2 good ones. I was actually just building a timeline for one of my talks here. What is your level of optimism in terms of the US being able to ultimately be persuaded by the arguments that people like us are making in terms of the virtue of embracing stablecoins within the US?
I think, unfortunately, near-term like stablecoin regulation doesn't seem to have a path to get done. It obviously got out of committee on the House side. It can pass the House, but the way it got out of committee with the Democrats strongly opposing it and stalling their indication that it won't pass the Senate, I think that that's pretty clear. So that's as currently proposed. I don't think that gets done, which is unfortunate. The argument against not passing clear federal regulation for stablecoin issuance, I have yet to hear a sensible argument on why you would not do this. Stablecoins are one of the most positive things for the United States from a whole variety of angles. And I know you talk about this a lot, but it promotes the US dollar use in international trade. It's cemented as the reserve currency. It provides a huge buyer for US treasuries. Tether is one of the largest treasury holders in the world now, which finances our government.
I looked it up. The stablecoin issuers would be considered the 16th largest sovereign nation in terms of holding US treasuries.
It's huge. And other foreign nations are pulling back from buying treasuries. So this helps fill the gap, which I think is meaningful. It also gives, and this one should, I think, resonate with US lawmakers, is it gives the US more control. If you look at stablecoins, there's a tremendous amount of transparency.
I mean, just look at the data in your report.
Look at the data
Try
in the
and
report.
run that
Yes.
for any other financial network. Can't be done.
Exactly. It can't be done. So huge amount of transparency. You can see what is happening. It's pseudonymous, yes. But at the end of the day, the vast majority of transactions and addresses can be tracked back to individuals right now by companies like TRM Labs. And even if you can't get tracked back to individuals right now, like the data's out there forever, you probably will be able to track it back at some point. So stablecoins and crypto in general are terrible to use for crime. I think that it'll actually be a boon for law enforcement agencies, is that dumb criminals will use crypto and there will be a massive amount of criminals that are identified this way. But the point I was going towards is, do you want the stablecoin issuers will answer primarily to the law enforcement agency and the governments of the country that they are based in and they are regulated by? And do you want these issuers to be answering to the US, or do you want issuers of tokenized US dollars to be playing by the rules set by a different country?
Yeah, and look at what's happening with stables right now is you're seeing crypto dollars emerge. We tried to coin this years ago, it didn't work.
It's a great term. People should use it.
Crypto Eurodollars. So Hong Kong now, I think there's already a Hong Kong USD stablecoin that exists. Singapore is on the path doing that. The EU wants to promote Euro stablecoins, so we can forget them for now. But undeniably, and Tether, of course, is already issued offshore. I don't exactly know where. Nobody knows, maybe. I did the numbers recently. About 75% of stables are what I would consider offshore. So it seems to be the case. We're still going to have dollar stablecoins. They're still going to reference a dollar because that's all anybody wants, 99% as a unit of account in stablecoins. But it's outside of the US. It's foreign issuers. They may not have the best interests of the US from a law enforcement perspective, from a sanctions perspective, from a financial policy perspective. They're not accountable to us. So why would we want that to happen? It is happening, though.
Yeah, it's terrible policy, I think.
It's remarkable that rarely is there a policy that's so clearly there's the right path and there's the wrong path, regardless of your partisan leanings, I think. And I just hope that it's a bit like the Eurodollar market and that the US eventually recognized its importance and its criticality and decided to fold it in to the financial regulatory apparatus. And now, of course, the Fed is very active with swap lines because there's all these Eurodollars elsewhere and they need to backstop them or support them, at least for a few allies. So I kind of think it'll be that way as well. Once stablecoins reach a certain threshold of size, eventually our beloved regulators here will acknowledge their importance and start to craft regulation around them.
Yes. Yeah. I think that we're still at the point right now where some folks think that stablecoins are just going to go away. Maybe they read the report and realize that that is not the path we are on and they need to embrace them. And I do think that there will be, over time, that the Fed will embrace stablecoin issuers. I think stablecoin issuers having accounts at the Fed and reserves being held directly in Fed accounts will get there eventually.
One of the funniest and weirdest, utterly bizarre things that central bankers believe is that CBDCs or better, more efficient real-time payments will obsolete stablecoins. They tend to believe that this is like conflict in the private sector and the public sector. And if we just make the public sector tools better, these private sector tools will go away, which is like an utterly comedic thing to believe that some crypto person who's maybe a user of Tether would be like, oh, we have Fed now in the US now. And maybe we have a CBDC in Europe, so I'm going to stop using my offshore crypto dollar. It's just an insane thing to believe. But a lot of central bankers do believe this.
Yeah. I think there's also oftentimes a conflation of what CBDCs actually could be. And that in most places, like an actual retail CBDC the central bank has no appetite for. The operational impediments to that happening make it, I think, virtually impossible in most places, including the US. So when people talk about CBDCs, they're really talking about like wholesale CBDCs, which is basically FedWire, FedNow. And then people conflate that with retail CBDCs, which are a totally different thing.
So I've had you on for a very long time. You've been very generous with your time, Peter, but we're going to do a lightning round now. And I'm just straight up stealing this from the Lightspeed guys, but it was fun. So we're going to do a lightning round of predictions. So just go with your gut on these. Size of the stablecoin market and aggregate market cap within, let's say, 5 years.
So I'm less focused now on supply, more on transaction volume. I think transaction volume over the next 24 months will get to 20 trillion in annualized volume. Over the next 5 years, I think we can get to 100 trillion, which would make it larger than the ACH network.
In terms of the market share of interest-bearing stables, today it's less than 1% within 24 months. Any guesses?
I think it could be more than 10%. I think definitely less than 50%.
Okay, that's an interesting one. Tether, will Tether exist in 3 years' time?
Yes, I think so. You said you think it will get folded up. I don't think so for a variety of reasons. I think the biggest one is Tether is a money printing machine at this point. Talking $1 billion a quarter type money. They have done questionable things in the past, which you pointed out, I think can largely be attributed, or at least partially attributed to they were operating outside the US financial system and they were going where they could. But now that they are where they are, if I was them, if I'm Paulo, what am I doing? I am running the most buttoned up ship you could possibly imagine, being very close with US regulators and making sure that that money machine does not get turned off. I don't know if they're doing that, but if I had to guess, they probably are. And I think there's also a misconception that Tether is not as beholden or not as responsive to the US or US law enforcement. If you actually look at number of banned addresses, amount of money that's been frozen, they banned 5 times the number of addresses as USDC. They've frozen, I think, 8 times as much value. So I think they benefit from that perception. But the reality is I think they are very responsive to US law enforcement.
Yeah. One of the amusing things is they're actually more interventionist than other stablecoins are. Who's your rookie of the year or project to watch? Like, do you have any that particularly interest or excite you from the stablecoin protocol perspective?
On the issuer side, I mean, PayPal coming in is huge. And then I think what Athena is doing is really interesting.
In terms of unit of account, so right now the dollar dominates 99% plus. It's always been like that. Euro, I think, is number 2. Depends if you count gold as one. I don't know if you count tokenized gold as a stablecoin. What would you say is going to be the runner-up here on a go-forward basis? I
think the euro is number 2 from a FX perspective in the FX markets. But if you look at the FX markets, the dollar is the base pair for well over 90% of transactions. And I don't know why stablecoins would be any different.
And you think it'll remain 95 plus dollars being referenced?
Yeah, absolutely.
It's been one of those remarkable things. When I plotted out, I couldn't even see the other foreign currencies on the pie chart. You can't even see it. It's just all dollars.
I mean, the reality is like the world wants dollars. The majority of global trade is in dollars. It's like people just want dollars.
Okay, keeping going with our lightning round here. Crypto-backed stablecoins. So whether that's DAI style, granted DAI is backed by RWA now, or in the past USDC. So maybe that's a bad example. But whether it's the synthetic USDs or maybe something else like DAI, maybe the other Reflexer Labs guys will create a new one. What market share would you expect to see them take in the next 24 months?
I don't know exactly what it is right now, so I don't have a good starting point. But I think that crypto collateralized stablecoins will increase, but at a slower rate than fiat-backed. So they'll lose share from wherever they are now, even though they'll be growing.
So right now, I don't know if you did this data for your report. I've been just, my poor associate's just been killing himself trying to get this data for me. Shout out Wyatt. You're doing a great job. Share of transaction value between native L1 cryptos and then stablecoins. I think it's around 70% right now. I don't have the exact numbers. Nobody does. Let's just say it's 70%. So this is on-chain transaction value. Where do you see that going? Obviously, it's been pretty linear, growing to 70%. Declining, growing, 95%. Where do you see it going?
That's a great stat. I did not have that stat. I love that you got that.
I don't have it either, frankly.
It's such a good stat. I mean, if that's true, which I hope it is, like that's amazing. That 70% of the value transferred on blockchains is in stablecoins and not like native tokens.
Up from 30% in 2020, which actually shocked me how high it was back then as well.
That's incredible. It's like blockchains are for dollars, I guess.
That's it. Yeah.
I think it would go up. I don't see a reason why that trend would stop. So it's 70% now, goes to 80% in the next 24 months, maybe.
Yep. Stablecoin legislation in the US before the election, after the election, where are you benchmarking that?
Near term, like the rest of this year, I don't think it really has a chance of getting done. Next year, I'm hopeful it will get done. I just think that people will come to their senses and see that this is such an obvious thing that everyone can agree on. And it's important to the US to get this right. And I think that they will.
Well, that's it for our lightning round. Maybe we'll revisit it in 2025. Let's see how you did. But Peter, this has been incredible. Really love the conversation. It's my favorite topic, pretty much my favorite thing. And frankly, I think if the only thing you cared about was stablecoins as an investor, that could completely occupy your time at the moment. So yeah, I'm going to obviously put your report in the show notes. Anything else you would say, people direct you who you want to reach, how to reach you? Yeah,
I'm on Twitter at the Chicago BC. DM me. That's probably the easiest way. Awesome conversation, Nick. I could talk to you for hours about stablecoins. I hope we get more opportunities to do this. So thank you.
Yeah, this has been great. Thanks so much.
Thanks for listening to another episode of On the Brink with Castle Island. To find out more about Castle Island, visit castleisland.vc. To listen to all of our podcast episodes, please go to onthebrink-podcast.com or just click on the tab in our website. Thanks for listening.